All right, so we pick up with stock dividends. So what is a stock dividend? Well, a stock dividend, first of all, can be taxable or non-taxable. It depends on how it's presented. Let's talk about non-taxable stock dividends. If the corporation issues certain types of stock, I mean, really, there's several things going on here. When a shareholder receives as a dividend stock, first of all, they're not receiving property or cash, although you might say that stock is property, but really there's been no change in ownership, assuming that it's a pro rata type of distribution to all the shareholders. I mean, if you own 50 shares of stock and you own 25% of the corporation, and they do what's called a 2-for-1 split, where your 50 shares turns into 100 shares. Well, everybody else gets a 2-for-1 split on their shares too. After the stock dividend, you still only own 25% of the corporation. So in essence, nothing's changed. You just have more shares at a lower basis, stock basis per share. So anyway, in order for a stock dividend to be non-taxable, the stock dividend has to be solely from common stock. In other words, the corporation can only issue in this stock dividend its common shares. So if there are preferred shares issued, then that's a problem. And these can be either voting or non-voting common stock, by the way. The dividend has to be a pro rata distribution, meaning everybody gets the same amount as it relates to their proportional interest. So in a 2-for-1 stock, if I own 50%, or excuse me, 50 shares, and I get 50 more after the stock dividend, I have 100 shares. Let's say you own 100 shares. After the 2-for-1 stock, I own 200 shares. We're still in the same boat proportionally. Now, what you do as far as the tax basis of those, the old shares and the new shares, is you simply allocate the basis for the old shares to include the new shares. And so you have this formula here, the fair market value of the stock received times the adjusted basis of the old stock is your numerator, and the denominator is the fair market value of all stock. And so that's going to be the adjusted basis of the new stock. They have an example in here. Where shareholder owns 100 shares and they paid $3,000, so that's the tax basis for those 100 shares. And in this example, Acme declares a percentage stock dividend of 100%. And so the shareholder who had 100 shares now has 200 shares. Now note that before the stock dividend, her 100 shares at $3,000 equals $30 per share as the book value or the adjusted basis per share. Well, now that this shareholder has 200, you simply take the 3,000 and divide it into the 200 shares. So, and it makes total sense. I don't want to, this doesn't have to be a simple or a confusing math formula. Basically, if your basis in the old shares was 3,000 and you had 100 shares, you had a $30 basis per share. Well, now you have 200, the same basis, full basis amount of 3,000. Your basis per share has now turned into half of the 30 or $15 per share. So pretty easy. Now note here that non-pro rata stock dividends are taxable. So what is a non-pro rata stock dividend? Well, let's say that you the corporation, offer shareholders either cash or stock. So they have their choice. Well, in that case, those who receive cash are going to have less as far as a percentage ownership in the stock, total stock of the corporation, whereas those who choose stock are going to have an increased interest in the total shares of the corporation. And so in that case, even for those who receive stock, because it's a non-pro rata stock dividend, it's a taxable event and it's taxed as a dividend. Now, how do you figure out what the dividend is? Well, it's the number of shares of stock that you select to take in the dividend, or that they offer in the dividend, times the fair market value of each share of stock that you get. That would be your dividend. Now, of course, for those choosing good old cash having a fair market value of the face value, that's going to be the amount of your dividend. And of course, as far as non-taxable dividends, I'm going back. The holding period for the new shares would be the same holding period as the old shares. In a taxable dividend, stock dividend, the holding period of the new shares is the date of distribution. Let's talk a little bit about stock redemptions. I don't want to get too deep into this, but I probably will, deeper than you want me to. All right, so what is a redemption? Well, that's when the corporation offers to buy from shareholders either all or part of their shares. And they do so in exchange for property. And when we talk about property here, we're talking about the same idea as when we were talking about property in our dividend conversation yesterday. So it can be cash, it can be non-cash property. And so a redemption can result in either a dividend or a sale of the redeemed shares. Well, why would you want one over the other? They're both taxed at, and usually the sale of redeemed shares is what, a capital gain, right? So they're both taxed at 15% preferential rate, right? So why would you want one over another? Well, you would probably want the sale, because with a sale you get to take into your formula for determining gain the basis of the stock that you sold. And so they have an example in the book where they redeem $100 to a shareholder. Very simple example. And the basis is $60. They end up with a $40 gain. Whereas if that's characterized as a dividend, you have to consider the whole amount. There's no basis against which to offset that $100 because you're not selling stock. You're just receiving a dividend. So individuals prefer exchange treatment rather than dividend treatment because they can take in consideration the basis that reduces the amount of their gain versus a dividend. Now, for corporate shareholders, that's not true because of the dividend received deduction. Corporate shareholders prefer dividends rather than capital gain treatment because of the DRD. And so 3 types of redemptions are treated as exchanges. If they don't meet the requirements under these 3 types of exchanges, the IRS will disregard the form of the redemption and declare that said redemption is actually a dividend, not an exchange. And so it's really difficult for corporations and individuals. Really, the individuals are the ones who have the burden here to prove to the IRS that a redemption is an exchange and not a dividend. So those some pretty strict rules here that you have to meet in order for it to be considered an exchange. The first rule is, and these are three separate and independent ways you can qualify a redemption as an exchange. The first is that the redemption is substantially disproportionate with respect to the shareholder. And so substantially disproportionate is kind of the key, the buzzword term here. And there are three bright line rules that you have to meet and prove in order to fall under this substantially disproportionate exception. And so the three stock ownership tests that you must meet in order for this to be qualified as an exchange are the following. Immediately after the exchange, the shareholder has to own less than 50% of the total combined voting power of all classes of stock entitled to vote. So that's called the 50% rule. And you know, they have to meet all three of these tests. The shareholder's percentage of ownership of voting stock after the redemption is less than 80% of his or her percentage ownership before the redemption. And last but not least, the shareholder's percentage ownership of the aggregate fair market value of the corporation's common stock after the redemption is less than 80% of his or her percentage ownership before the redemption. So that's a lot. And so they give you an example in the book. Shareholder owns 60% of the stock of corporation, and so in order to fall under the substantially disproportionate test, you got to meet this 50% and 80% rule. So how do you do that? If you own 60% of the corporation, after the redemption, how much at least must you own to meet the 50% and the 80% rule? Well, you'd have to own, to meet the 80% rule, you'd have to own 48% or less of the corporation after the redemption, because 48% is 80% of 60%, and the 48% is below 50% of the total ownership of all the stock, right? So you meet the 50 and 80% rule there. So you have to be pretty precise in how you do this. On top of that, and this can be a problem for stock in a corporation that's owned by different members of a family, you have what are called the family attribution rules, which basically deems any stock ownership by family members is owned by the shareholder who receives a disproportionate or a substantially disproportionate redemption. So you've got to consider those family attributes at the family attribution rule when determining the 80 and 50%. It's as if the shareholder not only owns their shares, but they also own the family members' shares as well. Redemptions, another type of redemption that will be treated as an exchange if you meet the requirements under this are redemptions that are in complete complete redemption of all of the stock of the corporation owned by a shareholder. Now, if it's a complete redemption, it means the shareholder selling all of their interest in the corporation back, or in the corporation back to the corporation. So they certainly meet, in our previous test, the 50 and 80% rule. So why do we have this? Well, mainly for close corporations owned by a family. In this case, the family attribution rules will not apply, because if they did in a family corporation, if they didn't not apply the family attribution rules, someone who redeemed all their stock under the family attribution rule would still be deemed to own the stock, right, of the family members. So anyway, they do away with family attribution rule under this particular type of redemption. And so there are some requirements in order to meet this. And so first is that the shareholder who is redeeming their complete ownership in stock to the corporation immediately after the exchange cannot be a shareholder, employee, director, officer, or consultant to the corporation. Second, the redeeming shareholder cannot acquire an interest in this corporation within 10 years after the complete redemption, unless they happen to receive stock in this corporation through inheritance. And then last but not least, the shareholder must agree to notify the IRS if they do acquire what they call a prohibited interest, which is having an interest in the corporation. Now notice this, that the prohibited interest relates back to the shareholder being a shareholder, but also an employee, director, officer, or consultant within that 10-year period. So if they do, whether it's by ownership or just, being back with the company as an employee or officer, they have to notify the IRS within 30 days of acquiring that prohibited interest if it happens within 10 years of the redemption. Last but not least, we have a redemption that is not essentially equivalent to a dividend. So the not essentially equivalent is kind of the key phrase here. Now, this is a subjective determination by the IRS, and it's based upon, as many things are, the facts and circumstances of a particular case. Having said that, the IRS usually looks to see the change in voting power and the shareholder receiving the redemption, their voting power must decrease and be below 50% as a result of the exchange before they'll even consider this test. So, anyway, those are the things you have to prove in order for a redemption to be treated as a sale and thus subject to capital gain, thus subject to a recovery of basis. If it doesn't meet these requirements, what happens? Well, it's treated as a dividend. All right, I think that's about it.